Costs play a role in setting the price because they set the floor for the potential price of the product. The ceiling is set by demand. That is, the price level at which there would be no demand for the product will be the ceiling, and the cost is the floor. Between those 2 points fall the optimal price of the product. However, it's important to note here that pricing in retail should not be based solely on costs. Over the next few lessons, we will explain why this is not a good pricing strategy for retail. So when we look at the costs for retail pricing, we want to determine what goes under the cost of obtaining this merchandise and make it ready for display on the floor. This is also the amount we are going to use later on when we calculate the item cost in order to calculate the gross margin for the product. The first cost that goes into that is the product cost as offered by the vendor or supplier. Let's say you want to source 1,000 pieces of t-shirts and the wholesaler sells them at $5 each, and this does not include shipping. So the first cost here is $5. On top of those $5, there are other costs that will stack up until getting the product ready to sell. These include shipping fees from supplier to our warehouses, custom charges, duties, and import or sales taxes if any insurance that was related to the shipment, value-added services at our warehouse to get the product ready, for example, receiving, sorting, labeling, and tagging if this was performed by a third party. Let's say that when we received this order, we paid $5,000 to the supplier, and we paid $600 for all the other cost lines combined. So we will take those $600 and divide them over the number of pieces in the order, that is 1,000 pieces, and then we will get $0.6 per piece. We will then add $0.6 to the cost of the item, which was $5, then we will get the final cost of $5.6. In the attached pricing template, you will find a box at the top right corner, so you can enter the total amount of the other costs and then add the quantity, and it will calculate how much you add to each item. So now that we have the cost of the item, we will take this and start pricing from here and calculate the margin based on this cost of 5.6 and not 5. We're going to get deeper into the pricing steps in a later chapter in this course. Companies may have different objectives from their pricing, based on their strategy and on their current stage in their life cycle as a company. Identifying those objectives is important before setting the right prices. For example, companies may have the objective to maximize their market share. For this, they might set a strategy to set the lowest prices in the market and gain a bigger market share and make money on the volume, and also by getting better deals from suppliers. This is commonly the objective for value and off-price retailers. Other companies, on the other hand, have the objective of product quality leadership. Those companies want to be product quality leaders in the market. They set their prices high to signify quality and premium product, but also at a level that does not become prohibitive for many consumers. Many premium brands have this objective. Other companies have a maximum market skimming objective. This is commonly used by fashion retailers and sellers of other seasonal products, where the price is set high with the launch of the new collection or at the beginning of the season, and then after a few weeks it starts to gradually fall with each markdown event. So we could be selling 30% to 40% of the collection at full price, let's say at 60% margin. Then we start a series of sale events where increasing levels of discounts are applied and lower levels of gross margins are obtained. The idea here is to extract the maximum amount of revenue and profit from the merchandise by selling it at different price levels and having different types of customers come at those price levels. Then, depending on how much product sold at what level of discount, we get the final realized margin from the entire collection. Finally, a company could be at a critical stage of its life cycle or could be having inventory or cash flow issues, and so it has a survival objective from its pricing. In this case, the company wants to raise as much cash as possible and clear its inventory as fast as possible, and so it sets its prices at a low level to achieve this objective and to just cover its fixed operating costs. Of course, this is a temporary strategy and objective to achieve survival, and then the company will need to follow one of the strategies suitable for its stage to get out of survival mode. Pricing for retail is more complex than pricing for simple products or services. That's because pricing for retail involves setting prices for many different products, hundreds or thousands of products at a single business. Each of those products and their respective categories will have their own supply and demand dynamics and competitive landscape. That's why the pricing logic while setting prices for a product mix is to maximize profit on the total mix, rather than pricing each product in isolation. For example, within your product mix, you will have products that are commoditized and there is a high competition for those products in the market. Pricing those products will need to take into consideration how the competition is setting their prices, and this in return might dictate a lower margin on this category. On the other hand, you will have another category where your product is highly differentiated and the competitive forces are very low. Also, this might be your core product that contributes the highest to your sales mix, and you have a loyal customer base for these products. So here you will be able to set the price at much higher levels than the other category and extract more revenue and profits out of this one. Then at the end, when combined together, the business will still achieve high margins, despite selling one category at low margins. But because the contribution of this category was low, and those lower margins have been more than compensated for by the high margins of the core category. So all in all, the business is still achieving good margins. So now let's assume if we followed the logic of pricing based on costs and applying a fixed markup or using a certain margin, which is the same logic of keystoning. For the highly competitive category, we will be losing customers to the competition because we are selling this category, let's say at a 50% margin, while it's a commodity and other retailers are selling it at 20 or 30% margin only. On the other hand, our main category that we could have priced at a higher margin, say 60%, because we have no competition there, we lost a lot of profits on that category too by setting lower than optimal margins and selling it at 50% only. So in total, we have lost revenue and profits by following an easy but suboptimal pricing strategy. To apply this concept, a retailer will set a target margin for the entire business. Then different margins for different categories that take into consideration the category contribution to the business and the market dynamics for its respective products, and all the categories together need to deliver the final target margin through their different sales volumes and gross margins. Now we will explore the different pricing strategies and methods that are relevant to retail and can be used for different products and categories in our business.